Is it true that borrowers with good credit may pay more for their conventional loans after May 1st? The answer is yes, but the yes needs some explanation. And that's what I hope to do in this video, because there were so many headlines that came out like the US is subsidizing high-risk home borrowers at the cost of those with good credit. They were also saying home buyers with good credit to pay higher mortgage rates, and Biden to hike payments for good credit home buyers to subsidize high risk mortgages. Okay. I would say all of those headlines are true, but it does need explanation. And that's what this video is for. Some are even saying that it may cost you more money than someone with low credit. And I'm going to explain that in a rare instance that may happen. All right. So now that we know the headlines, we know what we're discussing, I don't want you to start paying your bills late. Let's get into exactly how this may impact you, my recommendations for buyers going forward. I'll tell you that as well. And something that everybody's not talking about as much as they're talking about this, that could even have more impact than this change. So let's talk about exactly what is changing. Okay, number one, this is only for conventional loans. For all mortgages, there are typically only four main types. One is conventional, and that's backed by Fannie and Freddie Mac, which is considered to be private, but the government does have a strong hand on what Freddie and Fannie may do, because what they do in our economy does impact, our overall economy. So they're not really private, they're kind of private public, if that makes sense. But conventional loans, then you have the government loans, FHA, USDA, and VA. Those are not impacted by this change. So be very clear that this is just for conventional loans. All right, so the main thing that is changing effective May 1st is that the LLPAs, which stands for Loan Level Price Adjustments, these are changing. And this grid, I'm going to make it larger so you can see. This grid basically is what lenders use when they're assessing the risk of a loan. And they'll use things such as owner occupancy, the type of home you're buying, single family versus multifamily. But if Fannie and Freddie Mac release an interest rate of, say, 3%, this is just for an example, then they're going to go to this chart and say, well, this person is putting 10% down, their credit score is 720. How much do I need to adjust that interest rate to give them a quote for their interest rate for this mortgage? So they use tables like this, these loan level price adjustment tables, or they abbreviate as LLPAs, to determine what everyone's interest rate is going to be, because everybody doesn't get quoted the same exact rate. Now, what you're looking at this table, if they're in green, like a low green color, a low green or dark green, they're going to be saving money on their fee, their LLPAs, which can impact your closing costs and interest rate. They will be saving. And a lot of the savings are people that are putting less than 5% down. That's this green part all the way over to your right. Hopefully it's the same on the video. And then in the lower credit category right here, 660 or so, is green as well. So they're going to have lower after May 1st. Now, where all the controversy is, right? The people that are in above the 680 or so, you see all this red and kind of this orange, they'll be paying higher LLPAs after May 1st. Now, where the confusion comes in is we're making it seem as if, let me go back to the other slide. And even in my video, because I did another video and I took that down because I think, I wasn't explaining it well. So I wanted to make sure that I tried to explain it much better than I explained it before. All right. So the example that I want to give, and this is for illustrative purposes only, I'm not a lender. This is not exactly what it's going to be for someone. But for example, somebody prior to May 1st of 2023, say somebody with a 760 credit score was putting 10% down, and they were going to be offered a 3% interest rate. Now, after May 1st, they'll be offered a 3.25% interest rate. So their interest rate will be increasing under that table that we saw. Now, for example, a person with a 660 credit score, and say they're putting 5% down, in the past, maybe they would have been offered a 5%. Now they're going to be offered a 4.5%. So people with good credit are still going to get the best rates, but people with lower credit scores are not going to get such higher rates, right? So they're not going to pay more. They're going to save, where people on the higher credit side are going to spend more after May 1st. It's not going to be as expensive for someone on the lower credit end or the low down payment end to use a conventional loan product. And it will be more expensive for somebody that's putting at least, according to the table, over 5% down. If they're putting more money down and they have a higher credit score, their fees will be more. Not more than low credit borrowers, but just more in general. They'll be paying more than what they would have been offered prior to May 1st. So that's where I wanted to make sure I cleared that up for you guys, that it's not that higher credit people are paying more than lower credit people. Is that they're paying more after May 1st than they would normally pay. And then people with lower credit scores and lower down payments are going to pay less after May 1st than they would normally pay. Okay. And I'm going to put links to everything that I'm discussing down in the description of this video so you can read it in more detail. Now, the Washington Times said, and this was on Fox News, home buyers with credit scores of 680 or higher will pay about $40 per month more on a home loan of $400,000. Home buyers who make down payments of 15 to 20% will get socked with the largest fees. And that's going back to the table that I just showed you guys that they're pulling this information from. Okay. So it just needed some explanation, right? So now I want to also go over something else. Fannie and Freddie Mac, to compete for the most part with FHA to offer a lower down payment option, they have something called Home Possible and Home Ready. And this allows buyers with certain low to moderate incomes, a lower down payment is 3% actually, so lower than FHA. You only have to put 3% down, and your credit score can begin at a 620. But there are income limits to this. So if you see any articles that may allude to, people using a certain program may be able to save more than people that don't qualify for this type of program, that might be true because the loan level price adjustments are waived for these two programs. So for Home Ready and Home Possible, and I've done a video about this several months ago, if not a year ago. I'm going to, after this video, you have the option to choose a video. I would watch that video next because Home Possible and Home Ready, they're giving you, these options. So if they're comparing like somebody using Home Ready or Home Possible to somebody that may not qualify for Home Ready or Home Possible because they're over the income limit, then they may be able to say that they may be paying a little bit more, all things created equal, than somebody that's not eligible for these programs. Now, why is this change occurring? And I'm going to make sure I show this large. According to the director, Sandra Thompson, the Federal Housing Finance Agency is taking another step to ensure that the enterprises advance the mission of facilitating equitable and sustainable access to home ownership. So they are trying to encourage more people to become homeowners. And that is a big part of some of the things that they are trying to do. Now, I'm not saying this is perhaps the best way to do it. They could have lowered the cost for everyone because a lot of times a lot of people are pushing to make sure they have a higher credit score, a bigger down payment, and that would help them, right? Get the best loans and that sort of thing. And it still will. It just wouldn't help you as much. So, and with everything being equal, I know there's a lot of data about credit scores and that not being a good indicator of repayment. But we kind of have to, at this point, right, unless we change our elected officials, and I'm not getting into politics right now, that you have to, use this structure as best as possible. This is going into effect May 1st. So you want to be mindful of that. I'm going to give you some recommendations, okay? Well, first, before I give you my recommendations, I wanted to share one additional thing that a lot of people are not talking about. In bigger news, also, in addition to the changing of the LLPAs, there are also borrowers with over a 40% debt to income ratio are going to pay more with conventional loans. This will impact about 35% of borrowers that qualify for conventional mortgages. And that's what Experian has said, that they anticipate this impacting that amount of people that have traditionally bought over that DTI threshold. So this may make conventional loans more expensive for some people. Now, one of the huge benefits of conventional financing is that you can get rid of the mortgage insurance once you reach 20% equity, where with FHA loans, you have to pay the mortgage insurance for the life of the loan. Unless you put at least 10% down and then you have it for 11 years. And even with the conventional, as soon as you get to that portion of equity, you can ask for an appraiser to come out, reappraise your house, and for them to remove the mortgage insurance, which that is not an option for FHA loans at this time. So, you really need, and that's part of my recommendations, because I've had, clients that have bought in 2020 and were able to remove their mortgage insurance within 2 years because home values rose so quickly. So, my recommendations and thoughts, and this has always been what I've said, is to get multiple quotes, but I want to make sure that you're not just quoting one loan type. And mortgage lenders are going to adjust to these changes as well to try to find you the best loan products. But as you communicate with lenders, you want to make sure that you're not just quoting for one loan type. FHA may be more advantageous for you than conventional, perhaps, with these changes. So you want to make sure that you're asking at the time, hey, how does it look for me if I do a conventional loan? How will it look for me if I do a FHA loan? Assuming you don't qualify for USDA or VA financing. So you want to have those conversations with lenders, and lenders, now that has changed some of the fees, they may, do a better job of explaining both loans and which one would be best for you. Get quotes with different down payment amounts. As you saw in that matrix, your down payment amount does matter. So you want to talk about whether or not it's worth for you to put a higher down payment, lower down payment, that sort of thing. Should you go in at the lowest? And then there's something called recasting that lenders may, advise you to do. Is basically, instead of you making the down payment, at time of purchase, maybe you make it after and have them recast the loan. That's something you may want to explain, want to discuss with your lender if that is a better option for you. Because I know a lot of people, number one, they've been trying to get their credit score as high as possible. They've been trying to save as much money as possible, and it may not be as beneficial as you may think. So, like I've said in a lot of my videos, go ahead and get pre-approved and have these discussions early, because the things that you're doing may not be, may not benefit you drastically financially. And you want to have those conversations as soon as possible. And then see if you qualify for Home Ready or Home Possible. This program has already, been available. It's 3% down. It's a conventional loan, so it has lower mortgage insurance, and you can, eventually get rid of that mortgage insurance. So you want to look into this, especially like when you're thinking about FHA or conventional. Talk about to your lender Home Ready or Home Possible. I have a video that'll play next after this. And then my thoughts are, this may impact people with definitely cash out refinances, because the whole matrix is changing. So it doesn't only affect people that are purchasing a home. If you're refinancing, doing a cash out refinance, it may, impact you as well. If you're buying investment property, it's probably definitely going to impact you, because those are minimum down payment. So you may have a 20% minimum down payment, and then your credit score, you're going to pay a higher fee after May 1st as well. So those of you that are thinking about investing, buying rental property, you want to make sure you're getting at least 3 quotes. And then this may take some buyers out of the market because those interest rates are higher, those closing costs are higher. And, we'll have to see. We don't know what the impact is going to be. A lot of people, I watched a lot of videos all weekend about this on both sides of the issue. Some people are saying this will help people that typically could not qualify, or it was costing them more money for these types of loans, qualify for financing. Some people are saying this is, putting a burden on people that have higher credit scores and down payment money where they have to pay more. Again, not more than somebody with low credit, but more than they would have paid in the past. And so it could also help people on the low end. And I watched it and it was a kind of a back and forth, but this is the largest change in the LLPAs since like the financial crisis that they're doing in the last 15 years. This is the most sweeping change. So there's going to be some time period that we're all going to have to adjust and see if this makes sense. But that's what I wanted to share with you all so you understand it. If you have any questions, and I'm sure you may have some, please put them in the comments and I'll be happy to answer those. I just wanted to make sure that I was explaining it with more detail than I did in the past. Thank you so much for watching. Please like and subscribe to my channel for new videos every week.